When we dispose of a non-current asset, we're going to need to follow a set procedure, and that's going to require the creation of two new accounts. Now, new account number one will actually be one of two types. It's either going to be what's called a profit on disposal of asset account, which is a revenue. So you can see here, it's either going to be a revenue if we've made a profit on this disposing of the non-current asset, or it's going to be a loss on disposal of asset account, which is an expense, and we'll use that one if we make a loss when we sell a non-current asset. The other new account we'll need is what's going to be called disposal of asset, and we'll need to rename that. We'll need to change this word here to whatever asset is we are disposing of at the time. So laptop, vehicle, or office equipment, whatever it is, we change that to say disposal of laptop, for instance. Alright, let's use an example to demonstrate how we're going to use these new accounts. So we've got a laptop that we bought at the start of 2015. It cost $2,000. Year one, we'd appreciate $400. We're left with a carrying value of $1,600. Year two, we'd appreciate $300. We're left with a carrying value of $1,300. And then year three, we'd appreciate $200, which gives us a carrying value of $1,100. So at the end of the asset's third year, we're going to dispose of it, and we're going to get $800 in a sale. Now, just looking at that, we estimated that there were $1,100 of unused economic benefits left. That's what the carrying value represents. But we could only sell it for $800. So we have made what's called a loss on disposal of $300. So let's look at the ledgers though, as they exist. We'd have a laptop ledger with a debit of $200, showing the laptop's balance. We'd have an accumulated depreciation ledger, so it had $400, $300, and $200, so that was a total of $900. And lastly, we've got some cash from selling the laptop, so we'd have a debit in cash for $800. So what we need to do is first of all create the first new account. Now it's either a profit on disposal, which is a revenue, or it's a loss on disposal, which is an expense. And it doesn't matter whichever circumstance it is, we're going to shut that ledger at the end of the period to the profit and loss summary account, just like we do with any revenues or any expenses. Now in this example with the laptop, we're going to need this ledger because we ended up making a loss on disposal. So let's figure out how we would do this. The second new account we're going to need is what's called the disposal of asset account. Now in this case we've changed the word asset. We write the name of the asset that we're disposing of. So we've changed that to say laptop because that's the asset in this case study. So that's a temporary account. It exists on balance day only. It shouldn't exist the next day. It should close to zero. It's a repository, and basically that's used to transfer all the other accounts. That's its sole function. So looking at laptop there, that's an asset. But we just sold that asset. So we need to reset the balance here to zero because we don't have the laptop anymore. Now the ledger we're going to use to do that is called disposal of asset. So we can see it's a repository where we send all the other ledgers. The second ledger we had was accumulated depreciation. Now after 3 years we had accumulated $900, so we better shut that down with an entry there, but we need somewhere to send it. So we will send that to the disposal of laptop account. The third ledger that we had was we got $800 cash from the selling the laptop. Well, if we do a debit in cash, we need to match that up with a credit somewhere. That'll go in the disposal of laptop account. And lastly, we had what was called a loss on disposal of the laptop, which was an expense. So that was going to be a debit, but that needs a matching credit, so we'll send that to the disposal of laptop. So what we'll see is at the end of the day, this disposal of laptop account will actually balance to zero. It shouldn't exist tomorrow, and that's its sole purpose. It exists purely to get rid of the balances from all these accounts. But at the end of the day, it shouldn't actually continue in the next period, so we should shut it down and make sure it balances to zero. Where would we do this? What journal would we record it in? Well, the cash received part, we would do that in the cash receipts journal, but all those other entries, no, they didn't involve cash being received. Any cash paid? No, we didn't pay any cash. We didn't make a credit sale. We didn't make a credit purchase of stock. So we will record all of those transactions except for the bit where we got the money in the general journal, and we'll use a memo as our source document.